Okay, good day, everybody. Hope you're being safe today and everything's going well for you. Today, we're going to finish off chapter 5, and then we're going to move into chapter 6, talking more about audit planning and what we do at the front end of the audit process. The other day, we got up to the point where we were talking about materiality. So I'm just going to review a couple of the PowerPoints that we have previously talked about, and then we'll move into some actual calculations of materiality. So in this PowerPoint that we're looking at right now, it talks about what materiality is. It tells us it's one of the important judgments the auditor must make, and it affects our planning, the examination being the actual procedures that auditors do, and as well as the type of audit reports that the auditor might deliver to the users. And what is materiality? So at the bottom of the PowerPoint, it says it's the largest amount of uncorrected misstatement. Okay? Largest amount of uncorrected misstatement or error that might exist in financial statements that still present fairly the company's financial position and results of operations. So this is essentially a judgment call made by the auditors as to how much error can exist in the financial statements without affecting the user's decision. Right? Whatever that amount of money is, that's what our materiality is. And that's an important number that the auditors have to decide based on their experience and their knowledge of their client, and of course, their knowledge of who the users are. When we talk about materiality, we indicated the other day there's two types of materiality. The first one is financial statement materiality, and that's where the focus of that materiality is really on the users. And that is essentially, we say, something is material and should be disclosed in the financial statements if it would affect the economic decisions of the financial statement users. Okay, so that's a very high level concept. And again, that's essentially, we can look at that in terms of a number, right? Number of dollars, or we may look at that qualitatively, right? And say, well, there might be something qualitatively that might be material to the users. And so if something would affect the decision of a user, it should be disclosed. And so when we look at accounting numbers, we know that, as we've talked about some of the frauds that have occurred in the past years, we know that when we put numbers into a financial statement, that the numbers, they're not perfect, right? There's a lot of estimates which are used in accounting, and mistakes, being honest mistakes, can actually occur. So we have some degree of inaccuracy, right, that appears in every financial statement because we use so many estimates in accounting. And so all of these uncertainties that creep into the numbers cause auditors to use also a second type of materiality. So this is called performance materiality. And we mentioned the other day, there's a gap between financial statement materiality and performance materiality. And performance materiality is always a lower number. Okay, performance materiality is lower than financial statement materiality, and it's meant to allow a gap or room for error to exist in the financial statements without that error causing a material error in the financial statement. Again, the error that we're referring to is essentially error caused by misstatements in estimates, for example, okay, or innocent errors that might occur in the preparation of financial statement. Right at the end of this PowerPoint, it mentions performance materiality leaves a cushion, right, for misstatements that were undiscovered. So because auditors themselves are not perfect, of course, they want to try and reduce their risk. So there's typically a gap, and I mentioned the other day, I believe, performance materiality is usually approximately 25 to 30% lower than financial statement materiality. So for example, in an audit, the auditors might decide that financial statement materiality is $1 million, but that performance materiality might be $700,000. Auditors want to leave a gap, right, have a lower number for performance materiality as part of their risk management process to ensure that they don't get sued. But they also have to realize that the lower that performance materiality number is, the more work they have to do, right? And so if they have to do more work, that's going to increase the cost of doing the audit. And as cost increases, you may have difficulty with your client as to whether they want to pay the fees or not, right? Associated with the auditor using a performance materiality, which perhaps is too conservative or too low. So when we talk about materiality, it's got both a quantitative aspect to it. So we have to actually select a dollar amount. And it also has a qualitative part to it. So the quantitative part we'll talk about in a minute, but we always have this qualitative part. Right? Again, it's going to be in the judgment of the auditor as to whether certain information might affect the decision made by a user, regardless of what the amount is. You might have a very small dollar item, but it might be considered material by a user of the financial statement. Okay, so for example, let's say financial statement materiality might be $1 million and performance materiality is $700,000. However, let's say that there was a loan made to a director of the corporation for $100,000. Right? Well, the $100,000 quantitatively is well below our materiality limits, but qualitatively, right, you can see that a user of the financial statements might be interested in knowing that a director of the company received a loan for $100,000 because such a loan would not be in the ordinary course of business, right? So auditors, again, would have to use their judgment in terms of what type of information would be disclosed with respect to that loan to the director, okay? So these are significant judgment calls made by the auditor. And of course, from time to time, they may run into disagreements from management with respect to what the auditors feel is material and what management feels is material. Okay, and that idea I just mentioned a few minutes ago, we mentioned the other day as well. Some of the other examples here where small misstatements, right, or small differences might be material. So one common would be, if we showed a small net profit in our income statement, but there was an error which would have turned that into a small loss, right? And so that would be material because the shareholders would say, well, instead of a profit, we actually had a loss, right? So that might be considered material. We might have a change in earnings, right? And which shows a difference in trends. And so our profits going up this year versus last year, or our profits going down this year versus last year. Right? The trend of the earnings can affect what users believe is going on in the company. So again, the auditor, when they look at the financial statements, have to consider not only the dollar amount of error, but the message, right? What's the message that's being sent in the financial statements? And is the message the proper message, right, that should be sent to the users in the circumstances? Okay. So we've mentioned, excuse me, we have a quantitative measurement of materiality. So what is it that we have to do to come up with a number? Well, unfortunately, as this PowerPoint states, it says auditors are generally left without definite quantitative guidelines to determine materiality. In the professional standards, there are no specific numbers stated, right, in terms of how you're going to deal with materiality and determine what that number should be. But yet auditors have to do this. So what they have listed here would be the most common methods from audit practice, okay, that auditors use to determine quantitative materiality. So for a public company, which is a for-profit business, the first one is the typical method, okay? So you take your income from continuing operations before taxes, okay? So it's income before tax from continuing operations. Whatever that number is, you'd multiply that by 5%, okay? So that would give you essentially a starting point as to what your quantitative materiality should be. And then typically auditors, they would not adjust it higher, they wouldn't increase it, but they might decrease that number. depending on qualitative factors, right, that they feel are at play in the circumstances. So, for example, if you were auditing the financial statement of a company and the company was going to be sold, right, after the year end, you may have concerns, right, that the financial statements do not contain error. So you may actually lower your materiality limit from the 5% of income from continuing operations to some lower number because of the risk that you have because the company is being sold, right? So you don't want the assets to be overstated. You don't want the revenues to be overstated. You don't want the profit to be overstated. So you're going to do more work by lowering your materiality level. Many private companies that I've mentioned before, many private companies are not audited anymore. But for those that are, again, the most common method to determine quantitative materiality would be to take the net income of the company before taxes, but also before bonuses paid to the owners. Okay, so in North America, it's very common to pay a large bonus to the owners of the business. So we want to look at the profit before that bonus, and then again take 5% of that number. Okay, so that would be typically that 5% of income before tax. Right? In a public company, it's income from continuing operations, so that your discontinued operations don't affect the calculation. And then in a private company, as I mentioned, income before tax, but also before any bonuses paid to the owners of the business. Now, for other types of entities, especially not-for-profits, when we talk about not-for-profits, not-for-profit entities do not have a profit, right, or a loss in theory. They balance their budget basically each year. So there is not a profit measure on which to base materiality. So for not-for-profit entities, normally what we do is we'll take a percentage of the revenues. And as they say here, anywhere from 1/2 to 2% of revenues. So in a very large not-for-profit, you would take something in the range of 1/2 to 1% typically. In a smaller not-for-profit, you would take something in the range of 1 to 2%, right? A larger percentage because the base number is smaller. In terms of mutual fund industry, we would look at the net assets, right, of the particular fund. So again, 1/2 to 1% of the net assets would be a common measure that's used in practice. And then for real estate companies, same type of thing, right? Very often real estate companies, they have nominal profits unless they actually sell a piece of real estate. And then they have typically very large profits, sometimes very large losses. So in that case, we're going to base our profit, our materiality calculation, again, based on revenue. Right? So we can see, depending on the type of business that we're talking about, not-for-profit, specialized industries, we look more at the revenue side, right, or some asset measurement, whereas in the for-profit world, we're looking more at the profit in the actual income statement on which to base our materiality calculations. It mentions here in the next PowerPoint, it says, in some circumstances, the auditor may select alternative financial statement items for establishing materiality. Again, that's talking more about the mutual fund industry as an example, right? Looking at net assets. So yes, because of the nature of the business, sometimes that is done. But again, normally we're looking at the income in the income statement. Now, they make a point here, your income sometimes in business, it may fluctuate quite a bit, right? So from very high to very low, some years it may have losses. So how are you going to measure your materiality? So normally what you do is you normalize the profit, okay? So let's say the profit this year was $1 million, but we had a very large write-down of inventory, which was unusual, of $2 million. So we take $1 million, add back the large write-down of $2 million, and say our normalized income is $3 million. If we had variability of income, so let's say last year's income was $4 million, this year it's $1 million. Right? Should we base our materiality on $1 million? No, typically what we would do is we would average this year and last year. Sometimes we average 3 years. Again, it's going to depend largely on the amount of variability in the data. So if we took just this year and last year, in my example, 1 million and 4 million, right? That's $5 million dollars, let's say, profit before tax. So an average of that would be $2.5 million. times 5%. Right? So yes, very often we normalize the income where there's unusual gains or losses that affect the profit or loss. And then normally, yes, we do average over at least 2 years, sometimes 3, depending on the degree of variability of the profit. Again, there's no one who's going to say, right, should you use 2 years, should you use 3 years? It's in the judgment of the auditor, right? Knowing the client and depending on the circumstances that they're facing, right? So you see, auditing involves a lot of judgment, right? And that's why typically to become an audit partner in a large firm, normally you have to have approximately 8 to 10 years to 12 years of practice before you would ever be made a partner, because of the need to make these judgment calls. Right? You can't do that typically in your first 2 or 3 years of experience. You're just gaining experience and learning how to make the judgment calls. After a fairly lengthy time, right, of being involved in decision making around audit opinions and the audit process, then yes, you're in a position to make judgment calls. And typically that's around 10 years of experience where someone might be promoted into the partnership of a firm. So quantitative, right, that's just coming up with a number using some of the methods that we just discussed. In terms of the qualitative measurement, right, that's very difficult. Again, it's going to largely depend on the situation that you're being faced with. So some of the factors, right, that you might want to consider, right, the user, right, who are the users of the financial statements, what's going to be important to them, maybe the nature of the item or what the issue is in the particular company, right, that it might affect what might be qualitative in a company. So for example, nature of the item, if we thought about an oil and gas company today, right, oil and gas, we sometimes call dirty fuels, and the world is moving quickly towards forms of clean energy, right? So the fact that we have an audit client, right, involved in an old business, right, qualitatively, we might say, there's going to be more concern about the profit of this company, and so we're going to use a lower materiality limit, right, just because of the nature of the business. We might want to consider what's going to be the effect on share price, right, of the company, depending on the audit results, right? So of course, we don't want the share price to be affected by our audit result. So typically we would want to make sure that the audit result is the correct result. And so we might decide to use a lower materiality limit, right? As opposed to in a private company, of course, share prices are not relevant because shares are not quoted, right, on a stock exchange. So again, depending on the situation, different factors can have different bearing on your qualitative materiality decision. One thing to be aware of when we're talking about materiality is auditors, as they do their audit work, they find typically various errors, right, that exist in the financial statements. And so what do auditors do? Well, as they detect these errors, they add them up, okay? So auditors, in the course of their audit, they may have known errors, right? So an invoice, let's say, was for $5,000, but we actually paid $6,000. There's a known error of $1,000. Or auditors also identify potential misstatements, because we know in accounting, some of our numbers are subject to discretion, analysis, judgment. And so, for example, the client might record an allowance for doubtful accounts of $1 million, but based on our audit work, we think it should be 1.2 million. So is there an error of $200,000, the difference between 1.2 million and 1 million? It's not a known error, but it's a potential error, right? And so auditors are, when they do their summary of their errors, they're going to have actual known errors, such as we paid $6,000 on a $5,000 invoice, but they'll also have other potential misstatements. So they also add those up, because they want to see what are the actual errors and what are the potential errors, right? To add those up and determine how do those numbers compare to our materiality in the audit. Now, when we have more than one error, okay, this part, the particular PowerPoint, it says, considering 5 errors of $15,000 each, to be immaterial is inappropriate when materiality is determined to be $50,000. So what they're saying is, if you had 5 errors and they're each $15,000, can you ignore the fact that when you add them up, it's $75,000? No, right? So by themselves, each $15,000 error is not material because it's below our materiality limit of $50,000. However, taken together, they are material, right? So the auditors add all the errors, right? So they'll add the known errors, they'll add up the potential errors, and are the total errors in excess of materiality? If so, the auditor is going to be talking to the client about making some changes to the financial statements before the auditors issue their audit opinion. Okay, so just so you're aware, errors are what we say additive, right? You have to add up the errors to see if the total is more than or approaching close to your materiality limit. Okay, we've already mentioned the concept of the overall audit strategy. Excuse me. And what we'll talk about more in the course is when audits are performed, we can use an internal control strategy where we test management's internal controls over their assertions that they make in the financial statements. And we also do, in that case, limited what we call substantive procedures. Or we can take, if management has a poor internal control system, we can take what's called a substantive audit strategy, which means we're going to put no or only very little reliance on internal controls. Or we can mix it up, put some reliance on internal controls, but also do some types of substantive procedures. Now, when I use the term substantive procedures, let me expand what I'm referring to. And we're going to see this later in other PowerPoints and other chapters, but I want to clarify it now. So when I use the term substantive procedures, there are 2 types of substantive procedures. The first one is analytical procedures. Analytical procedures essentially is ratio analysis. Okay, so doing things like calculating gross profit percentage, calculating working capital in a company, we're calculating the working capital or current ratio, calculating the debt to equity ratio, right? So all different types of ratios basically is what it is. That's analytical procedures. The other type of substantive procedure is what we call test of details, okay? Test of details. Test of details is simply tracing or vouching numbers that appear in the client's financial statements back to original accounting documents, okay? So if a client says we paid $5,000 for an invoice from our auditors, we should be able to go back and look at an invoice from the auditors for $5,000, right? We're tracking back or vouching back an expense to original source documents. So anytime you're looking at original source documents, that's called test of detail, okay? We're going into the detail to make sure the numbers in the financial statements are correct. Now, as the audit proceeds, okay, in this PowerPoint, it says audit planning is an ongoing iterative process. So we've talked about this before. At the beginning of the audit, we set the strategy, but we can change, right, the audit strategy and the detailed audit procedures as we progress through the audit. As we gather new audit evidence, right, we may change how we're going to attack the audit in terms of our procedures, okay? We might start off and say, oh, we're going to put a lot of reliance on internal controls. But then when we start testing the controls, we find out, you know what? Management's controls are poor. They're not working. Well, we better change our audit strategy, right? We can't rely on management's internal controls if they're not working. We're going to have to do more substantive procedures. Okay, and so we're constantly throughout the audit changing procedures as we gather new audit evidence, right? Because remember, at the end of the day, we have to have what? Sufficient, meaning enough, appropriate, meaning the right type of audit evidence. So as we go through our audit process, yes, it's iterative. We're backing up, going forward, backing up going forward, based on new audit evidence that we gather throughout the audit. Okay, so it's not just a case where we do the audit plan at the beginning and never look at it again. No, based on the new evidence that we obtain as we conduct our audit, we will alter our plan in an appropriate way. Okay, now when we do our audit planning, the second bullet point says the auditor shall establish an overall strategy that sets the scope, the timing, and the direction of the audit that guides the development of the audit plan. So timing, okay, so let's say our client has a December 31st year end. How much work are we going to do before the end of the year? And how much are we going to do after the end of the year? Okay. The direction and the scope of the audit, again, we're talking about, is our approach going to be testing internal controls and doing very little substantive procedures? Or are we going to test internal control very little and do a lot of substantive procedures? Okay. And by the way, where are our risk areas, right, in the audit? Right, the risk areas is help us determine the scope. What is it that we want to focus on, right, during the course of the audit in order to reduce our risk, right? That there's a material error in the financial statements. So all of these things are dealt with at the front of the audit process, but again, they're subject to change as we gather more audit evidence as we actually do our audit work. Okay. This last PowerPoint just talks a little bit about the details, so let me just walk through the steps with you, just adding a few more comments as we go through it. It says, in establishing the overall audit strategy, the auditor must first identify the characteristics of the engagement that defines its scope. Again, the characteristics we're talking about are the risks, right? What are the risks in the engagement? And that's going to tell us what we should be looking at, being the scope. B, ascertain the reporting objectives of the engagement to plan the timing of the engagement and the nature of the communication required. So the reporting objectives, what are our deadlines, right? If we have a December 31st year end, when do we want to issue our audit report to the board of directors and management? Depending on what that timing is, that's going to impact, right, when we're going to actually do our work. C, consider the factors that in the auditor's understanding and professional judgment are significant, right? So again, that's going to be largely looking at the risks, right? And managing the risks by doing audit work in the areas of risk to ensure that we do not have a material error in the financial statements. D, consider the results of preliminary engagement activities, and where applicable, whether knowledge gained on other engagements performed by the engagement partner for the entity is relevant. So again, that's the audit partner typically. The way that audit engagements are managed by firms is one partner, for example, might handle a number of clients in the oil and gas industry. Another partner might handle clients in the media industry, right? So they gain industry expertise, right, by handling clients in certain industries. So they may have other knowledge, right, from other clients that might impact the engagement planning. The preliminary engagement activities, again, we mentioned the other day, getting management's draft financial statements before we even start the audit, doing some analysis on those financial statements to identify numbers which look unusual, right, unusual trends, right? So we're going to use that information to plan the audit. Okay, so all of these things in item E says ascertain the nature, the timing, and the extent of the resources to perform the engagement. So based on all of the above, what's our deadline? What type of work do we have to do, right? What type of staff do we need at the audit firm to accomplish the task, right? Do we need staff with a lot of experience, or can we get by with staff with not a lot of experience, right? How many years of experience should our staff members have? So these types of decisions enter into the audit process in terms of who's actually going to do the work, right? If an audit firm has a client which is very high risk, they're probably not going to put just their new partner on that audit engagement. They're going to take a partner who's been around maybe for 10 or 15 years as a partner, right, to handle a more difficult audit engagement. And again, that'll be part of the risk management of the firm, okay? All right, so that finishes off chapter 5 in terms of some more discussion around how audits are planned. And the most important part here that we talked about so far, of course, is the determination of materiality. Okay, so let's go forward then into the next chapter, which will be chapter 6. And I've just mentioned this a little bit already this morning in terms of assessing the risk in an audit engagement. Just excuse me for a minute. My throat's getting a bit dry. From an audit firm's perspective, they want to manage down the risk, right? Lower the risk so they're not sued. Well, how do auditors assess risk in an audit engagement? Again, I'm just going to bypass over the learning objectives. We'll deal with this as we go through the actual material. So the first part talks about what are the essentials of assessing risk in an audit engagement. At the preliminary stage of audit planning, the auditor will take a high-level view based on the nature of the business. Right? We've already said how important it is to understand your client's business, the environment in which the business is operating. Right? Is it a fast-changing environment or not? The financial strength of the firm being audited, the corporate governance that's present in the firm, right? Do they have a good board of directors that's actively involved in monitoring management or no? Right? So based on these different factors, they're going to make what we would refer to as an overall, but still high level, right, assessment of the risk of material error in the financial statements. So for example, if you thought the board is actively involved in overseeing management, you would probably think there's less risk of material misstatement. If the financial strength of the firm is good, you would think there's less risk of material misstatement. So it's just common sense, isn't it? On the other hand, if financial strength is poor, that might make it necessary for management to try and manipulate the data. So there would typically be a greater risk, right, of material misstatement. Or if the board of directors, right, only meets once a year and really isn't closely aligned with management in terms of overseeing their performance, well, then that also might lead you to believe there's a higher risk of material misstatement. Right? So the auditor is going to look at these different factors to make an initial assessment. Okay. Now, when we talk about audit risk, okay, there's essentially 3 different components of audit risk. So in our formula here, and this is actually one of the most important formulas in the entire course, so make sure you're comfortable with this one, okay? AR is audit risk. Audit risk is a function of 3 types of risk. IR, that's called inherent risk. Inherent risk is really determined by the nature of the item or business that we're talking about. So for example, a jewelry store. A jewelry store would have fairly high inherent risk, right? Because it's fairly easy to steal, right? A piece of jewelry, rings, right? You could put a ring in your pocket and walk out the door. You could put a watch right on your arm, see what it looks like, just walk out the door. So a lot of jewelry is small, right, and can easily disappear. So the inherent risk is high. Then we also have to look at CR. CR is control risk, okay? Really talking about internal control risk. Is the internal control system of management strong or weak? Meaning, will management's internal control system prevent, detect, and correct errors in the financial statements, which are material? If management has a strong internal control system, then control risk is low. If management has a weak internal control system, control risk is high. Right? A weak internal control system means that the internal control system may fail to prevent, detect, and correct errors in the financial statements which are material. Okay? And then DR stands for detection risk. Detection risk is the risk that the auditor's own procedures will fail to detect and correct material errors in the financial statements. Okay? So during an audit, which of these risks are controlled by management and which ones are controlled by the audit firm? IR and CR, inherent risk and control risk, those are controlled by management, right? Because management gets to decide the type of internal control system they're going to have in their business. And of course, inherent risk is driven by the nature of the business in which management is engaging. So IR and CR, okay, are controlled by management. The only risk that the auditor performs or controls is detection risk, right? Again, that's the risk that the auditor's own procedures will fail to detect and correct a material error in the financial statements. Audit risk, remember, we said auditors, when they perform their work in such a manner to ensure that the risk of material error in the financial statements does not exceed 5%. Right? So AR, we can set at 5%. And then, of course, you can do the math, right, for the other three components. And whatever percentages you apply to IR, CR, and DR, you cannot exceed AR at 5%. If it does, you have to do something else, right, with respect to these three factors. But keep in mind, the only one the auditor can affect is DR, okay? And we'll be talking about this more as we proceed through the chapter. Now, inherent risk and control risk very often are difficult to separate from each other, okay, when you're actually analyzing a business. So we put those two elements together, and that's why you see them in brackets here, IR times CR. We put those two risks together, and we call that the risk of material misstatement, right? So we have the inherent risk, depending on the nature of the business, and the internal control risk. Again, in CR, control risk is the risk that management's internal control system will fail to prevent, detect, and correct material errors in the financial statements. So the risk of material misstatement is what? The auditor's assessment of the probability that one or more assertions in the elements of the financial statements. What are the elements of the financial statements? Assets, liabilities, shareholders' equity, revenues, expenses, gains, and losses. Okay, so those are the elements. So the risk of material misstatement is the auditor's own assessment of the probability that one or more assertions about assets, liabilities, equities, revenues, expenses, gains, and losses are materially misstated because of inherent and control risk. Assertions, here's another word, assertions about the elements. I just mentioned what the elements are. What are management's assertions about the elements? Now, we're going to be talking about assertions a lot more as well in the next few chapters. But management, when it prepares its financial statements, makes assertions about the elements in the financial statements. So, for example, on assets, one of management's assertions about assets is that the assets are properly valued. Okay? One of the assertions about assets made by management is that the assets recorded in the business are owned by the business. Okay? One of the assertions made by management about the assets in the financial statements is that they are accurately recorded. Okay? So we have a number of assertions made by management with respect to the various elements, assets, liabilities, shareholder equity, etc. Okay? So from the auditor's perspective, the auditor is just trying to determine what's the risk that those assertions about existence, right, accuracy, etc., what's the risk those assertions are materially misstated because of the inherent risk of the business and the internal control risk of management's internal control system, right? So the auditors are assessing that risk. Depending on how they assess that risk will affect DR. So let's talk about that for a minute. So keep in mind, AR cannot exceed 5% normally. So if we said IR times CR is a high number, right? If we said IR and CR is a high number, that means DR must be what? DR has to be a low number, right, in order to have AR not exceed 5%. Detection risk, in order for that to be a low number, in order for the auditors to have a low risk that their procedures will not detect, right, and correct a material error, what would the auditors do in order to lower the detection risk? They would do more audit work, right? So when the risk of material misstatement defined by IR times CR is high, DR must be low. Auditors must do more work, which means the cost of the audit is going to go higher. On the other hand, if the auditors assess IR times CR, if the risk of material misstatement is low, and we don't want AR to exceed 5%, that means DR can be higher, right? The auditors can take more risk that their own procedures will fail to detect and correct material errors in the financial statements. Why? Because the auditors are saying management's own system of internal control is so strong that the internal control system will detect and correct the material errors. And because the auditors believe that management's internal control system is so strong, the auditors are going to allow DR, the risk that they take, to increase because they have that confidence in management system. So if auditors allow DR to increase, do they do more work or less work? If they're going to take more risk, that means they're going to do less work, right? If auditors do less work, that means the cost of the audit is lower. So let's pretend you're management now. If you want the cost of your audit of your company to be as low as possible, what should you do as members of management? You should take steps to ensure that the risk of material misstatement is low. You should take steps to ensure that your internal control system is strong. Because if your internal control system is strong, that means the auditors can rely on your system that you've put in place and allow detection risk to increase. That will lower the cost of the audit on your business, okay? And that's why in the business world, in most public companies for sure, they have and stress the importance of a strong internal control system because the management members know, because in part they've been told by their auditors, if you improve your internal control system, we can do less work and lower your fee, okay? But if management's not going to improve their internal control system, the auditors will not be in a position where they can do less work, meaning they have to do more work and keep the audit fee high, okay? So there's a lot, right, of thinking that goes on just with respect to this formula, both in terms of what should management's behavior be. Management's behavior should be to lower the risk of material misstatement so auditors can rely on the internal control system and take more risk, right, and do less work themselves, okay? As opposed to the opposite scenario where management says, we don't care about our control system. That means the risk of material misstatement is going to be high. So DR, the risk the auditors are going to take, must be low. So that means they're going to have to do more audit work. Okay. Again, we'll be dealing with these different parts of this audit. We call this the audit risk model. Okay, audit risk model. Audit risk, AR, equals inherent risk times control risk, which combined is called the risk of material misstatement, multiplied by detection risk. Again, detection risk is the risk that the auditor's own procedures will fail to detect and correct a material error in the financial statements. And then here's the three definitions, right, that I've just gone through with you: inherent risk, control risk, and detection risk. Okay, so you can, I've already talked about those, and you can review those at your own timing. Okay. The next PowerPoint talks about a business risk-based approach to auditing. What is that? Okay, so in the bullet point, it says the business risk-based approach to auditing requires the auditor to understand the auditor's business risks, management strategy for addressing those risks, and the business processes it used to implement the strategy. Right, so we want to look at how management controls the business. Right, we want to look at the risks that they face, how they're managing those risks, and their detailed business processes to implement their strategy around managing the risks. The reason for this is that if management is not managing its risks, that creates risk for the auditor. Right? So if management, let's talk about accounts receivable, for example. What's the business risk around accounts receivable? One of the business risks is that the accounts receivable are not collected, and we have bad debt expense as a result. So if management does not have policies and procedures in place to manage the risk around collection, then that creates a situation for the auditor where there could be bad debts, right, included in the account receivable balance at the end of the year. So the risk of bad debt expense is higher because management is not controlling that risk, right, a part of their business risk strategy. So we're concentrating on looking at how management is managing its business to give the auditors a clue as to where the risk areas may lie when they audit the financial statements put forward by management. Now, we saw earlier, in an earlier chapter, it mentioned when we look at business risks, right, there's two parts. So the strategic part to the business, right, what are our long-term goals and how are we going to achieve those? And then our business process, right? Our business processes refers to our daily routine documents that we have, segregation of duties, and those types of things. Do we analyze those types of things to say, do they support where we want to go as a business? So here in the second bullet point, it says at the end of the business analysis, the auditor should be able to determine if there are any weaknesses in the client's risk management process that could lead to a misstatement in the financial statements. So again, it's all about how is management managing the risk. There's strategic risk, right? Long-term risk as to whether we'll be successful in our business or not. But typically, and that one may relate from an audit perspective. If management's long-term strategy is poor, that might create problems for the auditor with respect to whether their client is a going concern or not, right? So in today's world, let's say Exxon Oil, right? Exxon Oil is a huge company in the United States, been around, right, for many decades. What is its strategy to survive in the business? Oil and gas is on its way out, right, over the next few decades. How is Exxon going to change? What's their strategy to go to clean energy, right? They had a shareholder meeting the other day. The shareholders are very upset. Why? Because they're not happy with management strategy to change their business from reliance on oil and gas to clean energy. Right? So Exxon Oil today is worth billions of dollars, but it may not have a successful strategy, right, to move into the future. So indeed, is it a going concern? So that creates risks for the auditors that they have to monitor to say, long term, is Exxon going to survive or not? If not, that should be reported in the audited financial statements. So auditors can have risk, right, in terms of reporting at a strategic level, but also, of course, the business process analysis. That's the detailed work that's done on a day-to-day basis in a business organization and looking at those risks. So, for example, accounts receivable collection, I mentioned a few minutes ago. If management does not have a business process in place to encourage prompt collection, that creates risk for the auditor, right, around whether the accounts receivable are properly valued at the end of the year or not. Right? So the risk that management takes in certain areas can definitely impact the auditor's decision around risk of different items that appear in the financial statements. So for quite a few years now, auditors have been studying, right, how management manages risk, because if they're managing risk well, that's going to reduce the auditor's risk of material misstatement. If management manages risk poorly, both on a strategic level and at a detailed operational level, that's going to create risk for the auditor in terms of their audit report on the financial statements. So again, there's a little bit more depth here talking about management strategic analysis. Right? So we won't look at all the bullet points, but let's look at a few just to explain it. So that strategic analysis, where do we get it from? Well, we have to talk to senior management, right? The CEO, CFO, board of directors. What is the strategy, right? How's it going to generate revenue and profit? So if we think about Exxon, what's Exxon's strategy to generate revenue and profit in the future? Once we learn what it is, does the strategy appear to be successful today and in the future? Some of the shareholders don't think so, right? What are the business risks and threats that prevent the entity from achieving its strategic goals? Well, what is Enron's strategic goals to start with? But the business risks relate to how fast are other companies going to move to clean energy, right? We know Tesla obviously is moving ahead with its battery development, moving to electric vehicles. General Motors, I think just last week announced, right? I think by 2030, most of their vehicles are going to be powered by electricity. Right? So if you're Exxon, right, this is 2021, you only have less than 10 years to transition your whole company to clean energy. And it's a multi-billion-dollar company. Can they do it? We don't know, right? What's their plan to do it, right? If they don't have a plan to do it, that's going to create going concern risks. The next point, what are the business processes, internal controls, and information systems, talk about computer systems, does the entity management use to manage the risk? Right? Are they on top of the information? How do they gather the information? Right? Do they have the information that they need to manage the risk or not? And of course, depending on what the analysis is around management strategy, how's that going to affect the financial statements? Usually in terms of going concern, right, long term. Is Exxon a going concern? Well, we're not too concerned about it today because they're financially strong, right? But if people stop buying oil and gas over the next 10 years, they're going to be in trouble if they don't transition to become a clean energy company quickly. Now, I would say myself, oil and gas is not going to disappear in 10 years, but it's probably going to be used to a much lesser degree. Right? So today, let's say maybe oil and gas has 80% of the marketplace, right? 85% of the marketplace in terms of energy. In 10 years from now, that might be down to 25%. Right? So Exxon better transition, right, into clean energy very quickly if it wants to survive. And that was one of the reasons yesterday, a few days ago when they had their meeting, shareholders were upset because at least what was reported was that the timing, right, of the plan by Enron to convert to a clean energy company is too slow. Right? So the shareholders say, no, you have to go faster than this. Okay. So on this particular PowerPoint, it says, what is management's response to risk? Right? Risk at the strategic level, risk at a business process level. So when we talk about risk management, we usually refer to that as enterprise risk management. and I've commented before, right? Many companies today, public companies for sure, have a CRO, Chief Risk Officer, someone who's looking at the risks inherent in the business and making sure that they're being properly managed. Okay, and of course, if they're not properly managed, this is in part what's going to create risk for the auditors of the business entity. Now, going into a more detailed, right, not looking at the strategic level, but looking at the business processes, right? That's what this PowerPoint is talking about. It says management will minimize risk through well-designed business processes. So business process, we're talking at a detailed level. So in my example, how will management ensure, right, that accounts receivable are collected on a timely basis, right? The next point says business process analysis deepens the auditor's understanding of the client's operations. Well, because we're getting into the detail, right? We call it the weeds. We're getting into the weeds. We're understanding how the business ticks. How does the company know that accounts receivable are going to be collected on a timely basis? Do they know it? Do they not know it? Right? If they're on top of it, fine. If they're not on top of it, that's creating risks, right, for the auditor. Okay. In addition, of course, we talked about a good internal control system. Part of what it does is that it ensures compliance with laws and regulations. Well, does your audit client's internal control system do that? Right? If the internal control system does not promote compliance with laws and regulations, that leaves the business open to fines, right? Financial losses, right? And so if a company might be faced with fines and financial losses, that's a risk for the auditor because we have to look at, has the company broken any laws or not, right? That might result in fines, okay? If so, some of those liabilities perhaps need to be accrued in the financial statements. Of course, a big part when you're looking at business process analysis, again, this is largely looking at internal control at a very deep level in the organization. Of course, in today's world, you have to look at technology, right? And how is management managing technology? And not only in terms of computer hardware and software that it's using, but we know in many industries today, e-commerce, right, is very important. Even doing things like bank transfers, right, e-transfers, that type of thing. But e-commerce referring to a retail business, for example, right? Or I'll mention a client, I've got a client who's in the gym business, right, physical fitness. And so last March, right, when COVID-19 hit, he, like many other gyms, the government said you have to close because we can't have this virus going around in your gym. And, he approached me soon after that and said, what am I going to do? I'm really worried about my business, blah, blah. And I said to him, well, I said, you have to transition your business from a Windsor business to a global business. You have to create a digital business, right, out of your gym business. And because he had the ability to do this in terms of being smart, he had knowledge of computer systems and software. Of course, he's good at what he does in terms of physical fitness. So he developed programs, right, which he now markets on a worldwide basis. So this business last March, all of their customers were in Windsor, Ontario. Today, they have customers around the world. He has customers in England. He has customers in France, Italy, Greece, South America, Mexico, various states in the United States. This is a little gym based in Windsor, Ontario. He's a global business now, right? And he was able to do that just in a very short period, 3 or 4 months, okay? But he had to transition, right? And that's what Exxon has to do, except on a larger scale, right? In terms of moving from an oil and gas company to a clean energy company. Can all businesses pivot like that and be successful? No. Many gyms, right? My clients' competitors, many of the gyms have closed permanently. They're not going to reopen. But the idea, when people say they work at home, well, we've experienced that basically over the last year, but you can also do physical fitness at home. And I know in talking to this client of mine, I've said to him, I think myself, physical fitness will continue to be done at home. Yes, some people will go back to a gym, but a lot of people will not because they like his programs, and they can just do this at home. And it's very cost effective, right? And so he's discovered, right? He's become a global business. He can't believe the success that he's had in a very short period of time. But again, right, it's not everybody that would have been able to do it. He had the knowledge, he had the drive, the perseverance to make it happen. He was small enough that he could pivot quickly. This is a problem for larger companies. They cannot pivot overnight. They can't pivot in 2 or 3 months, right? It's going to take them years to pivot because of their size, but they have to get started. Right? And of course, when they pivot, you need the systems in place, right, to get the proper information, the proper feedback to help you in that process. And of course, e-commerce systems, IT systems, what do? They produce data, right? So data is being produced for use by the financial statement users. How does management know that the data is correct? How does management know that the data is complete, right? And if management doesn't have controls in place to ensure that the information produced by its IT system is accurate and complete, that creates risk for the auditor in terms of knowing whether the data in the financial statement is real, right? Is it accurate and is it complete? If management doesn't know, how's the auditor supposed to know? Right? So the risk inherent in the system becomes a big problem for the auditors. Right? So the auditors, of course, naturally are looking at management and saying, what are you doing to manage your risk, both at a strategic level and at a detailed or business process level. Okay. All right. So I just looked at my watch here. I've been going on for a little bit over an hour. So let's just take a 5-minute break, okay? And I'll be back in 5 minutes to continue on. Thanks, everybody. See you shortly. Okay, everybody, we'll get restarted. Sorry, I had to go out and reboot my system there. Uh, so if you're watching the tape, that's what happened there. So continuing on with our the next slide, which talks about financial performance. And this is really something that goes on throughout the conduct of an audit. The PowerPoint states financial performance analysis continues the analytical procedures started earlier. This is really something, as I mentioned, it's you at the beginning of the audit, you do your initial analytical procedures to see what are the risk areas, what looks unusual, right? Are there some unusual trends? But really, this continues throughout the audit, looking at accounting policies, right, that management has completed or implemented. What's the relationship between ratios, right? So as numbers might change as you can do your audit, what are the ratios, right, that are changing in the actual financial statements? As you do your audit, is there any evidence that the profit or loss has been manipulated by management as a result of the interpretation of their accounting policies or underlying errors that you find in the financial statements? And then also you want to look at quality of earnings issues, right? And so what that's really referring to is, given your experience, if this is a recurring audit engagement, when you, especially for public companies, they report to the stock market each quarter. So if you take the profit reported each quarter for the last 3 quarters, right, and you add in the profit for the fourth quarter, that should be the profit for the year. But one of the things you have to watch is, does management make a lot of adjustments in the fourth quarter, which has an effect of changing the profit recorded in the first 3 quarters, right? So when management is trying to manipulate their earnings, they might make adjustments in the fourth quarter that effectively changes, right, what they've reported in the first 3 quarters. So correcting for errors perhaps and things like this. So this is something you're going to be concerned about as the auditor, because if management has to make changes at the end of the year, right, with respect to what they previously reported, that's suggesting to you that maybe their controls over financial reporting are not good, right? So that's something you always have to watch, is year-end adjusting journal entries made by management. Communicating with the audit committee, we've talked about this a lot in terms of the auditors need to communicate in a timely manner, right? So there's no surprises. That's basically how you want to run your audit, and that's how, when we think about a course, right, that we run here at the university, we want to try and run the courses so that there's no surprises, right? So obviously we're trying to make you aware of what the requirements are for you to do well in the course, right? What the assignments are that you have to submit, what percentage of your mark will count for each of the assignments, when the exams are, right? Giving you some input as to the nature or format of the exams. So that's all about managing the process and helping people become successful. In terms of communicating with the audit committee, we want to communicate things like what? Impact on earnings of implementing changes in accounting policies. So management might be looking at changing accounting policies. How's that going to affect their earnings, right? How about significant accounting policies in controversial areas, right? Are those issues or not? We want to talk about estimate issues, judgments in certain situations, uncertainties that may exist in some of the data or possibly in liabilities. We may want to talk with the board about unusual transactions. We may want to talk to the board about timing of transactions, right? Maybe there's a lot of sales in the last few weeks of the year, right? Maybe there were a lot of expenses incurred in the last few weeks of the year that management's trying to defer, right, to the next year. So there can be all kinds of things, of course, that the auditor is going to want to talk to the audit committee about. Okay, so this moves us forward now into the area about assertions. And this is a major part of the course, okay? Because at this level, we're talking about assertions made by management at a high level. These are what we call the financial statement assertions. Management, by putting numbers in the financial statements, is simply making assertions about that data, right? So in the first PowerPoint, or in the current PowerPoint, the first bullet point, it says, Assertions are claims that management makes in the financial statements. Well, what are some of the assertions that management makes in the financial statements? The first point here, management's accounting system produces a trial balance, right? Management arranges a trial balance in financial statements, making assertions about the numbers in the trial balance. The auditors are going to take management's assertions about those numbers and audit them to see if they are valid or not. Okay? So the financial statement assertions are made by management. The auditors, they want to ascertain whether management's assertions are valid or not. That's the auditor's objective, right? Is to audit management's assertions in the financial statements. Now, we're going to hear, again, as I mentioned, a lot about management's assertions. So the bullet point in this PowerPoint states the practical audit objectives are to obtain and evaluate audit evidence about the assertions made by management in the financial statements. 5 principal assertions cover the claims made by management in the financial statements. So these are the most important ones, okay? These 5 are the most important ones. There are others, okay, and we'll talk about those later today and in the course, but these are the 5 most important ones. Existence, okay? When we talk about existence, let's think about accounts receivable as an example. Management states accounts receivable exist. How do they exist? They exist because sales transactions have occurred, which created the account receivable. They exist because we have not yet collected the account receivable, right? So management's making an assertion that the accounts receivable exist. They're making an assertion that the accounts receivable are complete. All accounts receivable have been recorded. All sales were recorded, right, which generated the accounts receivable. We have not missed any accounts receivable. Everything that should have been invoiced and billed was. That's the completeness assertion. The completeness assertion is especially important with respect to liabilities. Management makes the assertion that all liabilities that should be recorded have been recorded. That's the completeness assertion. Management is saying the liabilities are complete. We've recorded everything we should have, okay? Very important to an auditor, of course, because if there are additional liabilities that should be recorded, what's the other side of the journal entry? Normally, it's an expense, right? Debit expense, credit liability. So if you had to make an additional journal entry to debit an expense, that means before you make that journal entry, management's profit is overstated, right? So auditors spend a lot of time in their audit to determine whether management's assertion around the completeness of liabilities is correct or not. The next assertion is about ownership. Ownership of the assets that appear in the financial statements, right? We own the land, we own the building, we own the equipment, right? We have the right to use those assets. Also, the obligations are those of the company as well. So we don't have personal obligations mixed in with corporate obligations, okay? And of course, coming back to the completeness assertion, all obligations are those of the business and they are all recorded. They're complete. Valuation. Valuation pertains mostly to the valuation of assets. So inventory, for example, management asserts is properly valued. Okay, so when we think about inventory, IFRS requires inventory to be valued at the lower of cost and net realizable value. So management is saying inventory has been valued at the lower of cost and net realizable value. Management is saying the capital assets have been properly valued. Valuation with respect to capital assets means that the depreciation and amortization process has been correctly applied so that the accumulated depreciation and accumulated amortization accounts are correct. Management is asserting that the presentation, right, of the financial statements is correct with respect to classification. So for example, in current assets, there are no long-term assets included in current assets. In long-term assets, there are no current assets included in long-term assets. On the liabilities, there are no long-term liabilities included in current liabilities. And similarly, there are no current liabilities included in long-term liabilities. In addition, the financial statement disclosure is adequate. Okay, in accounting, right, in IFRS, we have something called the full disclosure principle. The full disclosure principle means that all information, right, which could affect the decision of a user is disclosed in the financial statements. Management says that the presentation, as it affects financial statement disclosure, is adequate. The auditor has to determine, is it adequate, right, based on the judgment of the auditor with respect to their knowledge of international financial reporting standards. So from an auditor's perspective, these are the assertions, right, that the auditor is auditing. Okay, these are, again, these are only 5. There are others, but it says here, they call them the 5 principal assertions. Yes, these are the most important ones that the auditor is focusing on as they do their work. Okay, so again, there's a number of PowerPoints here that discusses each of the assertions. Okay, so I'm just going to roll through these. I've talked to them a little bit already, but I'll highlight some other information in the PowerPoints. So existence or occurrence, it says we establish with audit evidence that the assets, liabilities, and equities, that they actually exist, right? So if we show shareholder equities, were shares actually issued, right? So shares were actually issued. That's why we have shareholder equity. Did the revenue and expense transactions in the income statement actually occur within the year that we're auditing? And a key matter with respect to existence is cutoff. By cutoff, we mean that transactions are recorded in the correct period. So for example, if our year end is December 31st, 2020, if we have proper cutoff, that means there are no January 2021 sales included in December of 2020. Similarly, there are no December 2020 sales included in January of 2021, right? The sales are in the right period, the expenses are in the right period. We say cutoff is correct if the expenses and the revenues are recorded in the proper period. Very important concept in accounting, because if management wants to manipulate financial statements, an improper cutoff is often one way that that's attempted, and the auditors are always on the lookout for that. Completeness, as I mentioned, we want audit evidence that all transactions and accounts have been presented in the financial statements are actually included, right? So everything's recorded. No items belonging to the financial statement have been missed, right? We want to make sure, especially with respect to debts, that everything's recorded, but also with respect to assets, that everything's recorded. Now, where's the risk for the auditors? Do you think that management would miss recording any assets? No, right? They would record assets because that will maximize shareholder equity, right? The more assets we have, the higher shareholder equity will be. So management's bias is to do what? Overstate assets and to do what? Understate liabilities, right? If liabilities are understated, that means shareholder equity will be higher. And so that's the risk for the auditors, right? You want to ensure that auditors believe management will record all their assets. From the auditor's perspective, they also believe that management may not record all their liabilities, okay? And so again, that's a significant focus of the audit function, is to ensure all the liabilities are recorded because the auditors perceive that is an area of great risk. And again, you have cutoff issues, right? Are all the expenses recorded in the right period, right? So if you had goods delivered to the business in December of 2020, but not yet paid for, there should be an account payable, right, recorded in December of 2020 for the goods that you purchased. If that account payable was not recorded until January of 2021, you have a cutoff error, right, with respect to the debt. So auditors always do testing of transactions around the year-end date to make sure that sales are recorded in the proper period and to ensure that expenses are recorded in the proper period. Ownership, again, we talked about this a minute ago, establishes with audit evidence that amounts reported as assets represent rights to those assets, that you actually own them, and that amounts reported as debts or liabilities actually represent obligations of the corporation, right, as opposed to obligations of perhaps a member of management or obligations of another company. Valuation, again, refers to measurement and allocation. Allocation referring to allocation of cost, right, of a building or equipment through the depreciation process, right, is what that's referring to. Measurement, of course, referring to things like lower of cost and net realizable value as it pertains to inventory. Measurement would also refer to things like the allowance for doubtful accounts, for accounts receivable, right? Is that properly measured, right? So we're looking at measurement and allocation issues as they relate to the elements of the financial statement. Again, the elements being assets, liabilities, equities, revenues, and expenses, and they normally add in gains and losses, right? Because gains and losses, of course, result from the disposition of assets and liabilities. Presentation, whether the accounting principles are properly selected and applied in preparing the financial statements, and as I mentioned before, excuse me, whether the financial statement disclosures are adequate or not. Okay, excuse me for a minute. I'm just going to take a drink of coffee here. My throat's getting dry again. Okay, so when we do an audit, we're trying to ascertain whether management's assertions are correct or valid. So we may, as auditors, find misstatements, right, about management's assertions. So assertions, as it states in the PowerPoint, are the fundamental management claims that we're auditing. They're the focal point, right? Do the assets exist? Are the assets properly valued? Are the liabilities obligations of the corporation? Are they all recorded? Right? So the auditor, as they do their work, with respect to the assertion, they're just saying, what could go wrong, right? Is it actually correct or not? And then what could go wrong? How could that occur? Right? And so depending on what the answer is to how it might occur, that's going to tell the auditor what type of evidence they might want to actually look at to determine whether there's been an error or misstatement about the assertion made by management. So we're talking a lot about assessing risk, right? As we conduct our audit work. And as this PowerPoint states, it says auditing is fundamentally a risk management process. Right? Audit risk, again, when it says audit risk, think about inherent risk and control risk, okay? That audit risk is related to information risk that the financial statements are materially misstated, right? At the end of the day, when the auditors give their opinion, if the audit opinion is wrong, if the financial statements do not present fairly, that's the information risk, right? What we're saying could be wrong. So how do auditors try to lower the audit risk? Auditors strive to lower audit risk by performing audit work that gives them a high level of assurance that the statements are correct, right? So think about the risk of error, inherent risk, control risk. We talked about the audit risk model, right, a few minutes ago. If the inherent risk and control risk is a high number, detection risk must be a low number, right? So as it says here, to lower audit risk, the detection risk component, auditors have to do more work, gather more audit evidence, right? So as the auditors do their audit, the last point here, it says auditors need to assess risk in what they call audit-related terms. What is the inherent risk, right, of what we're looking at? What is the internal control risk related to what we're looking at, assets, liabilities, revenues, expenses, and then what's the detection risk, right, with respect to those various elements. So again, I commented about this a bit earlier, so a little bit of this PowerPoint will be repetitive. So apologies for that, but it's good to re-emphasize some of this information. The probability that an auditor will fail to express a reservation in their audit opinion that the financial statements are materially misstated is their audit risk. Right? The audit risk is the risk I'm wrong, that my audit opinion is wrong. Audit risk is greater if there's poor planning. Right? If I don't do a good job on my audit planning, I might not assess all the risk properly. I might do improper audit procedures. I might not obtain my sufficient appropriate audit evidence. Or I might do poor execution, right? Do the procedures improperly. I might do the wrong audit procedures, okay? Audit risk, it says, is dependent on user reliance. Of course, the higher the degree of reliance on the financial statements, audit risk is higher. So in a public company, right, the risk associated with financial statements is high because the shareholders are not present on a day-to-day basis, right, when the business is operating. They're heavily reliant on the financial statement produced by management. So in that scenario, audits of public companies is fairly high in terms of audit risk. For private companies, audit risk is lower. Why? Because in a private company, often a family business, the family members know what's going on in the business, right? Most of them are actually there on a day-to-day basis working in the business. So yes, the auditors will prepare the financial statements, but the information in those financial statements, the owners are less reliant on it because they operate on a day-to-day basis in the business. Right? So in a private company, typically audit risk is lower, right, compared to that of a public company. Okay. Then audit risk can also be related to account balances of different assets, right, of liabilities, and the financial statement disclosures. So for example, if accounts receivable form 90% of the assets of a business, the audit risk related to accounts receivable is high, right, because it's 90% of the assets. If there's a material error in accounts receivable, there's probably a material error in the financial statements as a whole, right? So the audit risk relating to individual account balances also has to be considered by the auditor. Just not the financial statements as a whole, right? It can be individual balances as well they have to pay attention to. Here's our audit risk model again, right, that we commented on at the beginning of class today. And we've already talked about the components, so we don't need to do that again. I would just note again at the bottom, it says auditors usually like to limit audit risk, so AR, they like to limit audit risk to less than 5%, 5% or less. The reason they say less than 5%, of course, is that's the maximum, right? Normally auditors want to assume. So they try and lower it below 5% by doing, of course, a lot of audit work. So what we say is in the conduct of an audit, auditors usually will give 95% confidence that the financial statements do not contain a material error. The auditors, as a consequence of doing their audit, normally will assume, right, that the maximum error amount would be 5%. There's no more than a 5% probability that there's a material error in the financial statements. But again, auditors normally do their procedures to reduce that percentage below 5%. Again, the next few PowerPoints talk about inherent risk, control risk. We've already talked about that, so don't need to go further, and we'll be talking about this more in the course as we go forward anyhow. The combined inherent risk and control risk, I already mentioned that. Let's just look at the wording though on this PowerPoint because that's an important concept. Remember, for the auditors, it's often difficult to separate the measurement of inherent risk with control risk. So they usually just combine them together and refer to that as the risk of material misstatement. That's what this PowerPoint is saying. Audit standards refer to the risk of material misstatement rather than to the two separate components because it's often difficult to separate them. Okay, and that's what it says here. It's often difficult to separate the two risks. Some controls are preventative, meaning that they try to prevent errors and reduce inherent risk, right? So if we have controls in place to reduce inherent risk, what's the inherent risk versus the control risk, right? Hard to separate the two. Some controls, it says, are only effective when misstatements occur. Will a control detect a risk, right? If it was to occur. So in that case, inherent risk and control risk, that relationship might be different. So it's just a situation where it's difficult to talk about the two risks separately. So let's just combine them together because from the auditor's perspective, what are they concerned about? They're concerned that there's a risk of material misstatement in the financial statements. Whether it comes about by inherent risk or control risk doesn't matter. No, the auditor has to deal with that risk and assess the risk and react to it in terms of how they do their audit procedures. So in total, we want to know what that risk is. How much relates to inherent risk and how much relates to internal control risk doesn't really matter because we're going to deal with it as a combined entity. Okay, and that's what the last sentence here says. The auditor may make a combined assessment of inherent control risk, which of course, normally, yes, that is what they do. Detection risk, I've already mentioned what that is. It's the risk that material misstatement is not detected by the client's control and will not be detected by the auditor. Okay, so the detection risk is the risk that the auditor's own procedures will fail to detect a material error in the financial statements. How can auditors control that risk? They control that risk by doing substantive audit procedures. Substantive audit procedures, right? I've already mentioned two types. Analytical procedures that are referred to here, and tests of detail, meaning going back to original source documentation, paychecks, sales invoices, etc., to verify the amounts that appear in the financial statements. Okay, so auditors reduce their detection risks, right, by doing substantive procedures. Okay, but by doing substantive procedures, that involves more time, right, which drives up the cost of the audit. The last point on this PowerPoint, it says at least some substantive procedures must be performed in every audit. Okay, so it's not a case where an auditor can just audit internal control and do no substantive procedures. No, on every audit, there must be a mix of internal control reliance work, okay, testing management's internal controls to make sure they work, and doing substantive procedures. The auditor, though, gets to decide what's the mix of the two, right? Am I going to do a lot of internal control work and minimize my substantive procedures? That's normally what the auditor wants to do. Why? Because that reduces the amount of time they have to spend on the audit, and that lowers their cost, right, of doing the audit, and hence they can keep their fee lower and more competitive. Management likes that, right? So that's why, though, it's important for management to have a strong internal control system so that the auditors can reduce their substantive work, okay? And when the auditors reduce their substantive work, the way they do that is they do more analytical procedures, which takes less time, and fewer tests of detail. Okay, if management's internal control system is poor and it's weak,
Then what the auditors have to do is more tests of detail, which increases the amount of time they have to spend on the audit and increases their audit cost. Okay, but on every audit, the auditors must do some amount of tests of detail. Okay, substantive procedures, which can be tests of detail or analytical procedures, depending on their assessment. Okay, so the audit risk model here is just showing you the various percentages right on this PowerPoint. And again, keep in mind AR, that's the key thing. That cannot be more than 5% in most audits, okay? And when you look at the components, do the auditors do an exact mathematical calculation like this? No, they don't. They just look at it intuitively, right? And they say, is my control risk, right? Is my risk of inherent, right? Risk of material misstatement high? If it's high, I have to lower my DR, which means I'm going to have to do a lot of substantive procedures. If I look at my risk of material misstatement and say it's low because management's control system is so strong, then the auditors say I can do less work, allow my detection risk to go higher, right, and still have AR not exceed 5%. But they're showing you the math here just to show you that the different components, right, can change, okay? And normally, as I said, the audit risk, you don't want to exceed more than 0.5, right? So that's why they're showing you the 0.5 here. But again, you can see, you can change these three components and still come up with 0.5, right? And of course, conceptually, that's what the auditors are doing. They just don't do it mathematically, though, like they're showing it here, okay? How materiality and audit risks are related. Materiality refers to the magnitude of the misstatement, right? It's the largest misstatement that could occur and the financial statement still presented fairly. Audit risk is the level of assurance that a material misstatement does not exist, right? So that's 95% in most cases, okay? It says the auditor will make these assessments independently, okay? So they look at them separately. That's what this PowerPoint is saying. They look at materiality and say what would be material, and then they look at the audit risk, right, and say how much audit risk am I prepared to take? In most public company audits, not more than 5%. In private company audits, sometimes they will take up to 10%, okay? The reason they'll take up to 10% in a private company is that the private company owners are working in the business, right? They know what the issues are. There's less information risk, right? Because the owners are aware of what's going on in the business, so there's less reliance on the audited financial statements, okay? And of course, when we have to deal with audit risk, we don't want it to be more than 5%. That means what? We have to make sure we have sufficient audit evidence and the right type, right? The extent. So sufficient, appropriate audit evidence allows us to reduce our audit risk to no more than 5%. It's in the judgment of the auditor how they're going to obtain the audit evidence. They obtain audit evidence by testing management's internal control system. They obtain audit evidence by doing analytical procedures. They obtain audit evidence by doing tests of detail. The auditor's decision is how much of each of those three types of work are they going to do, right, in the conduct of their audit. Business risk, it says, is an event of action that will adversely affect the company's ability to achieve its objectives and execute its strategies. Auditors need to assess the ways that business risk affects the risk of material misstatement, right? So that's what we've already talked about before. Strategic risk, business process risk, right? If management's not managing those risks, it has impact on audit risk, right? If management's not dealing properly with risk, it creates risk in financial statements, and auditors have to respond to that. With respect to the financial statements themselves, we've seen this before, but just as a recap, who's responsible for the financial statements? Management. If management's responsible for the financial statements, who's responsible for the assertions in the financial statement? Same people, management, right? The financial statement numbers, of course, that are produced in the financial statement, come from a financial statement system implemented and monitored by who? By management, right? So obviously management is in control, right, of the numbers produced. Management's in control of making the assertions in the financial statement. What is the auditor's responsibility? To audit the assertions made by management in the financial statements by obtaining sufficient appropriate audit evidence on which to base their audit opinion. Okay. Now, auditors, when they're doing audit planning, right, we can't sort of look at the financial statement as a whole and just say, how do we audit this financial statement as a whole? So what auditors do, and we'll see this later in the course, they break down or simplify their audit plan by looking at the different accounting cycles. Okay, so the accounting cycles, the first one, revenues and collection. So we used to call that triple R. Revenues, that's sales. Receipts, that's money coming in, right? Revenues, receipts, receivables, right? Receivables are uncollected revenues. So we have the triple R. Acquisition and expenditure, we used to call that the triple P. Purchases, payable, payments, right? When we buy something, it's a purchase. If we haven't paid for it yet, it's an account payable. Once we pay for it, it's a payment. Okay. Again, whether you call it purchases, payable, or payment, whether you call the first system revenue, receivable, receipts, doesn't matter which terminology you use. What's important is you recognize there's accounting cycles. Okay. Production and conversion, we usually refer to that as the payroll cycle, right? We pay people. Some of those costs are expensed in the income statement. Some of those costs are added to inventory, right? If we're a manufacturer. So the production and conversion process of materials into an inventory, for example. And then finance and investment, sometimes we call that just books of account, but finance and investment is referring to how do we raise capital? That's the finance. Do we borrow money? Right? Did we borrow money this year? Or did we issue shares in our company? That's the finance part. And then investment is simply when we receive that capital, what did we do with it? How did we invest it? Right? Did we buy capital assets? Did we buy shares of another company? Right? How did we invest the capital that we acquired? So auditors break down, right, the numbers that they have to audit in the financial statements into these cycles. And they develop an audit plan consisting of audit procedures to obtain sufficient appropriate audit evidence on each of these cycles. Okay? By auditing the cycles, of course, they end up generating the numbers that appear in the audited financial statements. Okay? So as we see as we go forward in the course, we'll be talking more and more about auditing in these cycles. So before the midterm, essentially we're setting the stage for the big picture about how an audit is done. After the midterm, we really get into the detail and looking at what types of internal controls, right, should management have in place in each of these accounting cycles that the auditor is going to audit. Okay? All right, so I think I've gone on long enough for today. Thanks for attending today, everyone. And if you have any questions, again, on anything I've commented on, feel free to send me an email. Otherwise, we will see you next Monday in class. Okay, have a good weekend and take care of yourselves. Be safe. We'll see you in a bit. Bye-bye.